Good afternoon, everyone. I hope you can hear me well. Welcome, everyone, to the webinar Personal Income Tax and Social Insurance Key Updates, effective from 2026. This session, organized by EuC Vietnam, with a strong collaboration between two sectors, Tax and Transfer Pricing Sector Committee, and also Human Resources and Training Sector Committees. And the session today will take about 2 hours, so that you can find more useful insight about new tax law on personal income tax and also a new regulation for social insurance, which we think that's very helpful your daily business. And for today's session, we are honored to welcome our guest speaker. The first one, I would like to introduce Mr. Thomas Max Lenz, currently tax partner of Deloitte Vietnam. He has a 40-year experience in international and Vietnam practice, serving many big international companies in Vietnam and other countries. He also the chairman of Tax and Transfer Pricing Sector Committee for more than 10 years. The second speaker is Ms. Nguyễn Đăng Thanh, currently director of Deloitte Vietnam, in charge of global employer services for more than 15 years. And the next speaker would be Ms. Vương Kiều Anh, currently the payroll manager of HR2B, one of the top registered company in Vietnam. And myself, Thắng Trần, as moderator, as I work for EuC for many years, we support a lot of activity for advocacy. And for the agenda today, we will cover about key topics as follows. Number one, the context and also the overview about new personal income tax law. The second is regarding about details for the key updates also from the current draft regulation at degree and circular level. And next thing would be the key updates for social insurance regulation effective from 26 onward. I hope that this session will bring a lot of value to all of you. One of the rule today is about the Q&A session. You don't need to wait until the Q&A session to raise the question. You can type your question in the chat box, so the moderator and organizer and speaker can pick up and discuss with you directly. Okay, and hope that during the session we don't unmute to ensure convenience and efficiency of the webinar. And I don't want to talk more, if you're waiting. I hand over to Mr. Thomas to begin the session. Thank you very much, and we enjoy the session today. Thank you.
Thank you, Thắng.
Yeah, Mr. Thomas, please control your mute. Okay.
Okay. Yeah, good afternoon, everyone. I'd like to start by providing just in a few minutes some background and context in relation to the new personal income tax law from the perspective of the tax reform journey in Vietnam and the social and macroeconomic context, which are interconnected. Tax reform has played an important role in the socioeconomic development of Vietnam. While I've been advising on Vietnam tax since 1998, just prior to the introduction of VAT and enterprise income tax, I think I can certainly say that I don't believe there's ever over that period been so much change in the tax regime and in such a short period of time as now, with all the major tax laws being reenacted. But it hasn't only been in relation to tax. There's been huge regulatory change overall, with more than 5,000 new and amended regulations being issued in 2025. It's an administrative reform project on a scale which has not been seen since the Doi Moi reforms of 1986. In addition to the merging elimination of government ministries, the total number of provinces and centrally managed cities has reduced from 63 to 34. The scale of transformation brings both challenges and opportunities. For businesses, adapting proactively to new requirements is essential, and we hope this webinar assists you with this in relation to PIT, which I'll now discuss on the new PIT law. In terms of the context of the new PIT law, there have been 4 phases of tax reform in Vietnam since the Doi Moi period. In the first stage of tax reform, from 1990 to 95, the Ordinance on Income Tax levied on high income earners was introduced in 1994. So it was a focus on high income earners, and it wasn't a law, but an ordinance. If there are Vietnamese participants in the audience who were working at that time and the late 90s, they'll recall that there were different tax rates for Vietnamese and for foreigners. Vietnamese were subject to an additional surcharge of 30% on income over 5 million dong per month. So there was a particular focus at that time in the provision of non-cash benefits by employers, and I think that sort of set the culture going forward. Although most of those benefits have been removed and the tax rates have come down. So in the second phase of tax reform, which is from 1997 to 2005, as I mentioned, that was when VAT and enterprise income tax were introduced. And the objective of that second phase of tax reform was to have a tax system that was relevant to the operation of a market economy. So coming on to the third phase of tax reform from 2006 to 2010, this was implemented to simplify the tax system and modernize the tax administration. As a result, tax became the main revenue source of the national budget and a tool for the government to manage and adjust the economy at a macro level. The reform of PIT was a key pillar of this, and it included a new, for the first time, law on personal income tax in 2007, which was effective from 2009. The law introduced the 7 tax brackets that we've had up until this year, with a top tax rate of 35%, and it removed the distinction between Vietnamese and foreigners and eliminated most of the tax-free and job-related allowances. So it's taken nearly 20 years, with I think a lot of stops and starts, for the 4th stage of tax reform, including the new law on PIT, but its implementation has been very rapid. I think those on the call will know that the law on PIT was only enacted in December 2025, with some provisions being effective from the 1st of January. I think the pace of change is unmistakable, particularly if we compare it to the implementation of the new PIT law. Compare the old PIT law to the new PIT law, when the old PIT law was enacted in 2007, but effective from 2009. So with such rapid implementation, there are provisions where there will be more detail. I think each of the articles in the law on PIT say that that article will be further elaborated on by the government. So this will be needed through guiding regulations and official guidance. We can see that even the implementation dates of the key changes, for example, the bans, has needed further guidance. So having discussed the tax reform context of the PIT law, I'll now discuss it in the context of macroeconomic and social background. I'd first say that Vietnam's not the only country in Southeast Asia which is reforming its personal income tax laws. In many countries, but Vietnam in particular, global minimum tax has been a very hot topic over the last couple of years, and Vietnam was the first country to adopt it. And this international tax for companies has emboldened policymakers, and the OECD is looking at developing new frameworks aimed at harmonizing personal income taxes across countries as well. I think this will be some way off, but we do see in Southeast Asia that countries are reforming their tax system with reference to common international principles. We can see, for example, in both Thailand and Indonesia, where they're on track for accession to membership of the OECD, that they need to align their laws in accordance with OECD standards and are likely to, well, they're already in the process of moving their tax regimes in line with OECD developments. So in the case of Vietnam, while PIT revenues have increased due to a growing middle class and rising salaries, PIT is still a relatively small proportion of tax revenues in Vietnam compared to other countries. The highest share of tax revenues in Vietnam, according to a 2025 OECD report, is from Social Security, which contributed 30%. VAT was next at 24%, and then CIT at 21%. PIT, while still growing, is still a small proportion of overall tax revenues compared to other countries. It's 9% in Vietnam compared to 16% in Asia Pacific and 24% in the OECD. I think a key objective of the new PIT law has been to address fiscal drag, i.e. the process by which, due to inflation and income growth, taxpayers have been pushed into higher tax brackets or into paying tax due to the level of personal and dependent deductions remaining static. Vietnam's economy is rapidly transitioning into an upper middle income status with GDP per capita of $5,000. While inflation is now at 3.25%, there was a lot of volatility over the time of the old PIT law, and it reached nearly 18% in 2011 before becoming stable at around 5%. Another objective of the new PIT law is to expand tax revenue sources, as well as improving social insurance policies to ensure the sustainability of the pension fund for broader coverage. We've also seen comprehensive digital transformation, including digital ID, synchronization to the National Population Database, and initial development of systems for data management and sharing amongst state agencies, notably, for example, tax and immigration. I think the digital transformation will inevitably intensify, for example, with respect to PIT administration, pre-populated tax return finalizations and automated tax refunds have been considered. We can see that the key focuses of the government are to drive economic growth, including encouraging, in particular, the development of local businesses, technology, and exports, as well as building up international financial centers. The government's focus is reflected in the new PIT law, with PIT exemptions for qualifying personnel working in digital technology, high-tech or strategic technology-related sectors, as well as Resolution 222 providing PIT exemptions for qualifying workers in the international financial centers, as well as PIT incentives in the High Phong Free Trade Zone. On the next slide, briefly, an overview that the National Assembly officially passed the law on personal income tax on the 10th of December, which takes effect from the 1st of July 2026. However, some provisions related to income from business activities and income from salary and wages of residents will be applied from the 2026 tax year. As discussed, the new PIT law marks an important adjustment in tax policy, with numerous amendments aimed at better aligning with the current socio-economic context and enhancing equity. I'll now pass you on to Ms. Tan, who will discuss the details of the changes in the new law as well as other updates. Thank you.
Yeah, thank you, Tom, for your sharing on the economic context and how the new PAT Law 109 has been issued by the National Assembly. So the very first point I would like to share with you is about a key change in terms of the tax treatment on employment income to see how it changed and impact to the taxpayer from 2026. And the first point we need to mention about is about the progressive tax rate applied on the taxable employment income of the resident taxpayers. So in comparison of the progressive tax rate in the old law and in the new law, you can see that on the left table, this is the progressive tax rate table under the old law, and on the right side, it is under the new law. And under the new law, the progressive tax rate has been already simplified. So in the past, we have 7 tax brackets, and now we just have 5. So we can see there is an elimination of the tax rate 15% and 25%. Now we just have 5%, 10%, 20, 30, and 35%. And also the threshold of the highest taxable income to be subject to the higher tax rate up to 35% has been also increased from 80 million Vietnam dong per month to 100 million Vietnam dong per month. So in combination between the change of the progressive tax rate and the increment of the personal and dependent deductions from 1st January 2026, we can see that there will be a lot of tax saving benefit offered to the taxpayer. And from the perspective of the individual employee, the monthly net take home may also higher than before. So to illustrate this, you can refer to 2 examples we present on the screen, where the resident taxpayer having the monthly taxable income at the rate of 40 million Vietnam dong per month and 110 million Vietnam dong per month. In both examples, we assume that the resident individual taxpayer has 1 qualified dependent. So in the first example, when the individual having the monthly income of 40 million Vietnam dong per month, if we apply the old progressive tax rate, you can see that the applicable tax rate will be up to 20%, and the monthly tax payable amount will be more than 2 million Vietnam dong per month. But now, if we apply the new progressive tax rate from 2026, then the applicable progressive tax rate will be up to 10% only, and the monthly tax payable amount will be 1.3 million Vietnam dong per month, coming up to the tax saving amount of around 34%. Okay. And in the example number 2, the resident taxpayer having the monthly gross taxable income of 110 million Vietnam dong per month, by applying the old progressive tax rate, the maximum tax rate in this case will be up to 35%, and the monthly tax payable amount will be more than 21 million Vietnam dong per month. But if we apply the new one, the progressive tax rate in this case just up to 30% only, and the monthly tax payable amount will be less than 17 million Vietnam dong per month, coming up to the tax saving benefit of around 19%. So in both scenarios, either the resident taxpayer, they have the income less or more than the maximum tax rate in the past. Now they still have the more tax saving benefit than ever. Okay, so this is the first change of the progressive tax rate. The next one we would like to mention about is the allowable tax deductions. So as Tom already mentioned before, from 1st January 2026, the personal deduction and dependent deduction will both increase. For the personal deduction, it will be increased from 11 million Vietnam dong per month to 15.5 million Vietnam dong per month. And similarly, for dependent deduction, it will be increased from 4.4 million Vietnam dong per month per qualified dependent to 6.2 million Vietnam dong per month per qualified dependent. So actually, this increment reflects the average income, and GDP per capita has also arisen around 40%, similar to the rate of increment in personal and dependent deduction compared to the last adjustment in 2020. And besides the family deduction, a resident individual taxpayer will continue entitled to the to be deductible on the contributions to the supplementary pension scheme and voluntary pension scheme under the cap amount as required by law. And moreover, they will also be deductible for the contributions to the charitable fund, educational sponsoring funds, as long as such organization and funds is for charity, for educational sponsor only, not for profit purpose. And this is the first time ever in Vietnam personal income tax practice. We see that the expense for the healthcare and educational training for both the taxpayer and their dependents will be also considered as the allowable deductions for PAT declarations. But of course, we understand that such expense should be supported by the relevant invoice and the proof of payment to prove that the payment is made by the individual taxpayer, not from other source. So this is the new point in the new PAT law. So we expect that there will be further guidance from the tax authorities on how we can implement and what kind of supporting documents should be maintained from either the individual taxpayer or from the perspective of the paying entity as the employer. So we will continue monitor and keep updated with the upcoming guidance from the authorities. The next one is the expansion of tax-exempt income categories. If you look into the new PAT Law 109, you can see that there is a list of tax-exempt income. But in the context of the sharing today, we just would like to pick up some key items that we would like to highlight to you because we understand they are the expansion of the category and they may impact significantly to the tax treatment currently applied by many organizations. So among the tax-exempt income, we noted that the income for the overtime, for the night shift, and the payments for the unused annual leave, which is back in accordance with the current law, will be considered as tax-exempted income. If you recall, in the old law, only the portion of payment exceeding the normal daytime or regular working hours will be considered as BT exemption. But now under the new PAT Law 109, as long as the payment is related to the overtime, night shift, and unused annual leave in accordance with the requirement under the regulations, then they will be considered as tax-exempt income. Okay, and the next one is the pension. Previously, only the pension income backed by the Social Insurance Fund will be considered as tax-exempted for BAT declaration. But now, under the new law, the income backed by the Supplementary Pension Fund or Voluntary Pension Funds will be also considered as tax-exempted income. Actually, this policy reflects the desire of the government to reduce the pressure on the social security system by encouraging the people to proactively contribute and participate in the supplementary pension and voluntary pension scheme, given that at the end of the day, they will enjoy the same favorable BAT exempted treatment on the income they receive from such funds, similar to the pension income they receive from the Social Insurance Fund. And the next one, the new PAT Law 109 also included the tax-exempt income arising on the employment income of the foreign expert working under the non-refundable ODA project or NGO project in Vietnam, and also the employment income of the Vietnamese individual working at the rep office of the International Organization of the United Nations system in Vietnam, and any individual participated in the United Nations peacekeeping force. So such kind of employment income will be also considered as non-taxable income in Vietnam. And the last one we would like to highlight to you is the employment income from performance of science, technology, and innovation tasks. Actually, this policy shows a very big focus of the government on the science, technology, industry, given that if you have the information in the draft proposal of the PAT new law, the government, they mentioned that if they implement this policy, this will lead to the reduction in the tax collection of around 1,100 billion Vietnam dong per year. Okay. And continue with the technology-related matters. In the PAT Law 109, the law also provides a PAT incentive specifically for the high-quality workforce in digital technology industry and the workforce in high-tech industry. So particularly for the digital technology industry, the PAT law offers the PAT incentive of PAT exemption up to 5 years on employment income for the personnel working in DTI, I mean the digital technology industry projects in the centralized DTI zone, or if they conduct the R&D projects, prioritize DTI products, semiconductor chip, AI system, or they execute the training activities related to the DTI workforce. And similarly, for the high-tech industry, the personnel having the employment income arising on the R&D activities for high-tech or strategic technology in accordance with a number of lists of the strategic technology products according to the high-tech laws will also be considered as having the PAT exemption up to 5 years. So look into the policy apply on the workforce in DTI and workforce in high-tech industry. You can see that not only PAT law, but the government, they also issue the law and other regulations specifically for such kind of industry. So it means that at the time the organization or the individual taxpayer would like to apply the PAT incentive, it is very critical that we need to look into the other laws and regulation as well to make sure that the required conditions can be satisfied to enjoy the favorable tax treatment. All right. So that's the key points we would like to highlight to you in terms of the change regarding the employment income. And besides the employment income, there are also other changes in terms of the business income and non-employment income. So firstly, we would like to address some key points in related to the business income. The first significant change we see in terms of the business income is the threshold used to determine whether individual or business household will be subject to Vietnam personal income tax on business income or not. So previously in the old law, the threshold for the business individual to be subject to personal income tax will be at the rate of more than 100 million Vietnam dong per year. But now under the new law 109, the business individual will only subject to Vietnam personal income tax if they earn the business income from more than 500 million Vietnam dong per year. So it's very clear that if the business individual having the business income more than 500 Vietnam dong per year, then they will need to declare and pay tax to the Vietnam tax authorities. However, for the group of the business individual having the income less than 500 million Vietnam dong per year, they will not hold the obligation to pay personal income tax. However, unlike the previous regulations, under the new law, they still need to report the annual revenue of their business income to the Vietnam tax authorities. And as far as we know, under the draft decree providing guidance on the calculating and declaring tax, it seems that the business individual having the business income less than 500 million Vietnam dong per year will need to report their annual revenue to the tax authority by 31st January each year. But this is just the draft decree, so please continue monitor and be updated with the upcoming official regulations. Okay, so that's the first point in terms of the threshold taxable income. The second point related to the business income is the tax calculation method. In the past, the old PAT regulations just offer one method to calculate the PAT on business income, which is the revenue-based method. But now under the new PAT law, they provide two kinds of tax calculation method to the business individual. The first one we call as the profit-based method. The PAT will be calculated as the net gain applied with the applicable tax rate. The applicable tax rate will be vary depending on the annual revenue the individual earned during a year. So let's say if the business individual having the annual business income revenue from more than 500 million Vietnam dong up to 3 billion, then the applicable tax rate will be 15%. Next, if their annual revenue is more than 3 billion up to 50 billion a year, then the tax rate will be 17%. And if their annual revenue exceeds 15 billion Vietnam dong per year, then the tax rate will be 20%. Okay, so this is the very first method, the profit-based method. The second method is the revenue-based method, which is similar to the guidance in the former regulations. The PAT will be determined as the annual revenue exceeding the threshold number of 500 million Vietnam dong per year, applied by the applicable tax rate depending on the activity of the business the individual hold. So please note that the method number 2, I mean the revenue-based method, is only applicable to the group of the individual having the annual revenue less than 3 billion a year. And this also applies to the case having the rental income. For any business individual having the business income, not the rental income, and having more than 3 billion a year, they should follow the method number 1, which is the profit-based method. Okay. And besides the business income, there are also certain changes in all the non-employment income. The first one is about the income from capital transfer. So under the old PAT law, the PAT on capital transfer will be calculated as 20% of net gain. There is only one method for the taxpayer to come up with a PAT on capital transfer in the past. But now under the new PAT law 109, the tax authorities, they provide two approach. The first one is the same to the past, that is 20% on net gain. And the second approach, which is the new one, they provide a guidance that the PAT can be determined as 2% of the transfer price in case the acquisition price and related transfer expense cannot be determined and supported by the relevant supporting documents. And please note that in the law, we see that the security transfer is still keep at the same compared to the past, that at the rate of 0.1% on total sale proceeds. And the next change is regarding the increment of taxable threshold for certain kinds of income, like income from bribes, royalty, commercial franchising, inheritance, and gifts. So in the past, such kind of income will be only subject to PAT when the value is more than 10 million Vietnam dong per time. But now under the new law, the threshold is increased up to more than 20 million Vietnam dong per time. And the PAT rate remains the same at 10%. And the very first time, there are certain types of income included in the taxable non-employment income. So you can see that the income from transfer of Vietnam national internet domains like .vn, vehicle license placed won through lawful auctions and digital assets will be subject to Vietnam personal income tax at a tax rate of 5% if the value more than 20 million Vietnam dong. And similarly, the very first time, the income from transfer of gold bars will be subject to Vietnam personal income tax at 0.1% on the transfer price. We see that this is one of the very hot topic recently. And the last one we would like to update with you is about the expansion of tax exemption income. So in the law 109, the income from interest on green bonds, income from the first transfer of green bonds after issuance, income from distributed after the CIT has been backed by private enterprise or single-member limited liability companies owner, income from the transfer of open-ended fund certificate issued under the security laws, provided that the certificates have been held for at least 2 years from the acquisition date, and 15% VAT reduction on investment income distributed to the individual investor from security investment funds or real estate investment fund established under the law on security for a period as required by the government. So this is the new items we see in the new law 109. All right, so that's the key points we would like to pick up in terms of updating you on the new PAT Law 109. Besides that, we see that back in 2025, there are certain changes in the regulations that we also would like to take this change to update and remind you, because we understand that it's also critical for both the organization and the individual taxpayer to be aware of and implement properly to not only leverage the PAT benefits, but also to avoid any potential risk of non-PAT compliance. So firstly, in terms of the PAT incentive, besides the PAT exemption on the employment income offering to the high-quality digital technology and high-tech workforce, as mentioned in the new PAT Law 109, back in 2025, we have the resolution 226 offering 15% reduction in PAT for a period up to 10 years for the personnel working in the free trade zone in Hải Phòng City. This offer to the expert scientists, individuals who are considered as the exceptional talent, manager, highly skilled worker. So the employment income they earn from their working in Hải Phòng free trade zone will be subject to 15% reduction in PAT for a period of 10 years. This is the first one. The second one is related to the PAT incentive at the International Financial Center, which we usually call as IFC. So under the resolution on 222, effective from 1st September 2025, the PAT on employment income of the managers, experts, scientists, and highly qualified professionals working at the IFC will be exempted from PAT until the end of 2030. And moreover, not only just the employment income, but the income from the transfer of shares, capital contributions, capital contribution rights to members of the IFC will be also exempted from the PAT until the end of 2030. So this PAT incentive have the primary purpose to attract the foreign investment, large financial corporations, and high quality workforce. So we hope that many of us can leverage such PAT incentive in the future. Okay, and the next one, we also would like to remind you that you can recall back in February 2025, the General Department of Taxation issued the official letter number A2A, mentioning that at the time, of submitting the withholding tax return, the paying entity as the organization need to also provide the detailed information of each individual, including the taxpayer name, the amount of tax withheld, the amount of tax already paid to the tax authorities. At that time, based on our observation, we see that the tax authorities, they would like to encourage the paying entity to provide such information from the tax year 2025 so that they can have a database to conduct the automated tax finalization and tax refund process at the year end. However, because at that time, this is a very new requirement just from 2025, and it's also not pretty clear on the sanctions. And we also received certain feedback from many companies that they face a number of challenges in providing such detailed information to the tax authorities. For example, they share to us that the confidentiality issue may be also their concern because anyone in the company having the right to access to the token, to access to the e-tax account, to submit such kind of information to the tax authorities, they can also have the full information of the whole organization. So in reality, so far, we noted that not all the organization as the paying entity provided such detailed information to the tax authorities. Okay, but however, recently, by end of November 2025, we see that the tax department issued an additional official letter number 5435 to re-emphasize the importance of this request, and they already sent to all the local tax authorities. In this official letter, the tax department also noted the inefficiency in collecting the detailed information from the paying entity, and they asked the local tax authorities all over the country to allocate the resource, the tax officer in charge, to keep track and follow up with the entities who yet provide such information to the tax authorities. So we understand that this movement indicated that the tax authorities, they would like to collect such detailed data more seriously in the time to come. So based on this development, we are in opinion that the organization as the paying entity should prepare for the circumstance where the tax authority may force you to provide such detailed information of each individual during the year. And you should think about how you can address your current challenge to comply with the request from the tax authorities. Okay. And the next update is regarding the PAT in terms of the meal allowance. So over the past years, the meal allowance provided in cash to the employee can be exempted from PAT at the capped amount of 730K per person per month. This already applied from 2016 up to now under the Circular 26. However, with the issuance of the Circular 003 taking effect from 15 June 2025, this cap amount is removed. And this leads to a significant impact to the organization because we see that at first, many organizations, they share their concern that now without the reference cap, they not sure how to apply the non-taxable treatment. And even if they set out the cap amount by themselves, they also worry that maybe in the future, when the tax authorities come to audit, they may deem that the amount set out by the organization may be inappropriate. But recently, from July up to now, we see that many local tax authorities, they issue a number of the official letters. And in that official letters, they mentioned that from 15 June 2025, if the organization, they can indicate clearly the amount of the meal allowance provided to the employee in cash in either the company policy, the collective, the CLA, and the employment contract, then that amount will be considered as the basic to apply for the non-taxable treatment. So based on that development, we recommend that the company should review all the documentation you have in your hand to see whether or not you already mentioned the terms regarding the meal allowance. If not yet, you should supplement the terms of the meal allowance in your internal policy or in your CLA or in the employment contract signed with the employees to make sure that the conditions to qualify the non-taxable treatment can be satisfied. Okay. And the next topic we also would like to remind you is about the decree number 49 issued on 28 February 2025. So when you look into this decree, you can see that the tax authorities, they classify the relevant taxpayer having outstanding tax debt into 4 groups. So we summarize 4 groups on the screen for you is the following. The group number 1 is the business. The group number 1 is the taxpayer having the tax debt, but now they no longer operating at their business address. The group number 2 is the legal rep of the enterprise having the tax debt from 500 million Vietnam dong, and the tax debt is overdue more than 120 days. The group number 3 is the individual business or household business owner having the tax debt from 50 million Vietnam dong, and the tax debt is also overdue by more than 120 days. So for such kind of 3 groups, the tax authorities, they will send a notice requesting the taxpayer to fulfill the tax obligations within 30 days. And after 30 days, if the taxpayer had yet fulfilled their outstanding tax payable, then the tax authorities, they will send an official document to the immigration department to temporarily suspend the exit of the individual out of Vietnam until they settle all the outstanding tax payable to the tax system. And until the taxpayer settle on their outstanding tax payable, the tax authorities, they will issue another document to send to the immigration department. And within 24 hours from the time the immigration department receive such notice from the tax authorities, they will lift the temporary suspension of exit imposed on that applicable individual. But unlike the first 3 groups, you can see that the group number 4 is quite special, including the Vietnamese citizen departing out Vietnam for overseas settlement, or the Vietnamese citizen residing abroad, or the foreigners prior to exit out Vietnam. As long as this group has the outstanding tax payable, they will face to the potential risk of suspend out Vietnam because there is no limitation on the amount of tax debt or the duration of the outstanding liability applied on this group. So long in short, you can see that as long as this happens, it will create a burden in terms of the financial risk, reputation risk for not only the individual taxpayer, but maybe also for the organization. So from our viewpoint, we suggest that the company and the individual should review carefully on your current status of the Vietnam personal income tax compliance to see if there is any mistake or there is any point you need to revise or to improve. Moreover, the organization should also proactively check the tax debt records in the tax system via your e-tax account to see if there is any outstanding tax payable you need to settle, and also to maintain the relevant supporting documents to facilitate the explanation and the tax debt reconciliation when required. Okay, so this is just to remind you. Okay, so after we go through all the key change in terms of the new PAT Law 109 as well as the change back in 2025, we would like to share with you some immediate actions plan we think it could be helpful to you. The first one is you should revisit the the payroll or PAT calculation system to make sure that you already update the new applicable deduction amount and the new PAT progressive rates apply on the employment income for the resident taxpayer. The next one is to prepare the updated process and to review the internal documents to optimize any tax efficiency regarding the change in the new PAT law. The next one, you may consider restructuring the compensation package you are currently having to optimize the benefit from change in PAT laws. And you should also keep track with the updates on the new guidelines, regulations, because there are certain points in the new PAT law not very clear at this stage to ensure that we can fully comply and leverage on the tax saving benefit in the new change. And one of the approach to make sure that you can be updated in a timely manner on the upcoming change is to proactively consult with the expert to address your questions and concern in terms of any new change in the PAT regulations. So that's on our proposed action plan to you. So I think we already go through the key points in terms of the change in PAT law. And maybe now I will hand over to Ms. Vang to continue with the update in terms of the social insurance. Yeah.
Chị không thấy em kéo em quay bằng Hello everyone. Thank you for being today. So my topic is about the social insurance. We have two parts. First, we talk about 10 major changes to the social insurance laws in 2024. And the second is critical hurdle for business implementation of the new this group. Then we talk about the 10 major changes about social insurance. First one, Vietnamese citizen age 75 and above who do not receive a pension are entitled to a retirement allowance. And the second, those who participate in voluntary social insurance are still entitled to maternity benefits. And third, expansion of mandatory social insurance participants. 4. The salary subject to social insurance based on the reference level wage, currently equal to the common minimum wage, 2,340,000 Vietnam dong per month. And point 5, the patient with long-term sick leave are no longer entitled to full benefit for 180 days. And the next, the employee who take half a day sick leave are still entitled to sick leave benefit from the authority. And the 7, all abortion cases are entitled to maternity benefits, means that paid leave under social insurance. The 8, employee contributed to social insurance for 50 years are eligible to receive a pension. And 9, employee participating in social insurance from July 1st, 2025 will not be allowed to withdraw their one-time social insurance benefits unless they fell under specific circumstances. And the last one, only children, biological parents, and parent-in-laws are entitled to their benefits when the employee passed away. So this is the general update about the new law of social insurance. Next slide, I will talk about the critical hurdle for business implementation of the new law. Number one, about the social insurance participants. Normally, the enterprise often overlook the rule when enrollment into social insurance, such as the internship, part-time employee, second seasonal employee, collaborator, and especially the new category mentioned in the law, directors and CEO management who do not receive a salary. So from the SR, we should to review all time contract of your employee or non-employee, including employment contracts of 1 month or more, seasonal contract, and collaborator with side employee contract to comply with the law. Second, correct determination of social insurance contribution, contractual salary, various allowances, and other supplementation payment in accordance with the law. So the enterprise should pay attention to the allowance stay on the employment contract. If these allowances are not subject to social insurance as per regulation, they should be stated in a separate section of the employment contract. And don't forget to include the clauses in the company internal regulation and the policy. Thus, we talk about the failure to accurately determine of the commencement time for social insurance contribution. There are 2 points. First is late registration for the social insurance for the new hire of 2 months or more. Then late notification of salary increase for employees from 2 months and more. Still, it leads to the risk of being categorized as social insurance evasion. And 4, the social insurance reference rate now is 2,340,000 Vietnam dong per month, currently effective from July 1st, 2024 until further notice. And we talk about the foreigner laborer. Foreigner employees who have already reached retirement age at the time of potential insurance enrollment are not required to register for mandatory insurance. That's all the point we highlight about the critical hurdle for business implementation of the new law for the social insurance. So we talk about the general information to social insurance today. We move to the questions and answer topic.
Yeah, man, thank to Mr. Thomas, Ms. Tan, and Ms. Vâng for very detailed and insightful sharing regarding the new BT law and also social insurance regulation effective from this year. It's quite helpful. We actually received a lot of questions in the chat box and also the question in the registration process 2 days ago. Okay, so let me pick up the question so we can one by one. Okay. I think the first question, actually, I got a question about 3 weeks ago from a CEO of Japanese company. Very general question about what do you think about positive change on the new BT law effective from 26 onward. So I think Mr. Thomas, I think you should the right person to answer this question because you work Vietnam more than 25 years and witness a lot of the change of law. So can you provide some comment on this? Thank you, Mr. Thomas.
Can you hear me? I can speak. I think yeah, you didn't prepare me for that question. I don't know about in terms of positive things. I mean, I think, as I said, the new PIT law has been a long time coming. I thought that there would be a lot of changes, maybe making the law more similar to laws overseas. I think there's a lot of when the PIT law was first enacted, and I think it still applies. A lot of it was focused on Vietnamese, and there's been a lot of some supplementary things, like if you look at, say, the taxation of share schemes, we have to go back to a ruling that was issued 20 years ago, whereas share schemes have become much more popular, much more complex, but we still don't have specific provisions. So I think overall, I would have preferred it if there was more detail and the law was more comprehensive. But I think the focus of the government has naturally been on the wide general populace and trying to get a number of people out of the tax system. And even though we've got these new provisions which have increased the bands, they haven't taken account of inflation. I mean, I used to always, like a rule of thumb, when do you start paying the tax of 35%? Well, say $4,000, and now it's about is it 3,800 or something like that. So it hasn't actually changed that much, but I suppose it's beneficial for the general populace in Vietnam in terms of the tax rates, which are good. And we see, I mean, overall, we see that Vietnam is able to focus on particular sectors because of the government structure, like technology in the export sector, and to promote and provide incentives. So I think those new incentives, I'm not sure whether we will get questions on those, because I think the detail in terms of the application process and how they will be implemented is still to come. But as other countries in the region are not able to, the governments are not able to focus on particular sectors. So I think that is very promising. But I'm not always completely positive. I do have some concerns, like with these rules on the preventing people from leaving the immigration, because we've had those experiences in our own practice, and it's a nightmare to get those people to leave, even where they've got a small amount of late payment penalty, and they come back to Vietnam for a holiday after working here for 10 years. So I think something practical has to be implemented in respect of that. But it's good if people can benefit from the technology incentives. Also, the International Financial Center will be good, but the proof of the pudding is in the eating, as we say.
Yeah, thank you, Thomas, for very practical sharing. I think that for my benefit, for example, I just received my salary today. I think my net income in will 2.5%. Recall that's amount, right? It's good for people. Okay, and all the things we can continue to raise our voice to provide more recommendation government to better implementation. Of course, we're still waiting for degree and circular level. So still have time. If you have anything that's to be improved, so you can raise the voice. Okay, thank you, Mr. Thomas. And the next question, I think this question raised a lot of people, not only here, but from other channel. So will the 5 new tax brackets stipulated under new law we apply from January 26 or from July 2026. So I think Ms. Tan, can you address this question?
Yeah, thank you, Anh Thắng, and thank you, Tinh Nguyễn, who raised this question. This is a very interesting question because we received from many companies from the beginning of the year so far. So before I can address it, I think we need to recall the legal basics of this. If we look into the effectiveness of the PAT Law 109, it mentioned that the provisions relating to the income from business activity and employment income of resident individual shall be effective from the 2026 tax year. Okay, this is the first point. The second point, in the articles number 8 and number 9 of Law 109, it also provided that the PAT on employment income is determined based on the taxable income applied with the progressive tax rate. And in the article number 6 of the Law 109, it also defined the PAT assessment period as the calendar year from 1st January to 31st December. So when we combine all the legal points I just shared to you, we can consider that the progressive tax rate to be a component of the overall process to determine the taxable income and calculate the PAT liabilities on employment income. So it quite makes sense that we can apply the new progressive tax rate from the tax year 2026. It means that from 1st January. However, because recently there are so many changes happen so fast. So during the transition period and prior to the issuance of the detailed guidance under the decree and circular, we also have a worry that there may be a different interpretations from a technical viewpoint to consider that the progressive tax rate should be applied from 1st of July. However, from our position, from the law position so far, when we work with many clients, we discuss with them and many of them, not saying almost, they agree to apply the new progressive tax rate from 1st January 2026 because the dependent and the personal deduction also apply from 1st of January. So it quite makes sense that everything should be aligned so that at the time we do the annual finalization at the year end, everything on the same page. Yeah. So just have a quick share to you.
Yeah, thank you, Ms. Tan. I think quite practical. It could be applied from January, but please pay attention to the further guidance. At least we have decree and circular. Yeah, I hope can be beneficial for everyone. The next question from Cheese. In December 25, the company back to salary in 2 installments. The first for December 25, and the second for the year-end bonus. Can BAT be withheld separately for salary and bonus due to the 2 separate payment time? So, Ms. Vân, can you have to provide comment on this? Thank you.
Yeah, thank you for the questions. So I assume that the both places have a long-term labor contract. So the employee must pay the social insurance as the first place with the long-term contract. And for the pay of health insurance, they will contribute as the place where they receive the higher salary. Yeah, that's all.
Yeah, it's quite clear, right? Yeah. Thank you. The next question, I try to elaborate the question, the social insurance contribution maybe. If one employee work for 2 companies, so do they need to pay insurance contribution in 2 places or not? Yeah, I think Ms. Vân can continue if you think it's relevant. Can provide comment on this.
If the employee work for 2 place company, means that with a long-term contract. So the employee have to pay the social insurance as the first company And for the health insurance, they will to pay as the company where they receive the higher salary.
Oh, okay, clear. So you only one company you pay the social contribution. Okay, thank you. The next question, may I ask if the company payment on behalf of housing rental for foreigner who sign labor contract directly with Vietnamese company is subject to VAT? I think Tan, can you help with this question?
Yeah, thank you, Thang. I repeat the question that the rental housing will be subject to Vietnam personal income tax or not if the individual employee sign the labor contract directly with the local entity in Vietnam. The answer is yes. However, the method for us to apply the tax treatment could be different depending on the arrangement of the house leasing contract and house lease rental payment. So in the first scenario, if the company provided the housing allowance in cash to the employee via the payroll, then full amount will be subject to Vietnam personal income tax. And in the second scenario, if the company, they sign the house leasing contract directly with the landlord, they pay the house rental expense directly to the landlord, and they have the legitimate invoice to be issued under the Vietnam company names and tax code, then the house rental expense will be subject to VAT, but not more than 15% of the total taxable income of the individual employee. So that's the difference. So in case you would like to leverage the VAT saving benefit, you may consider to have the employer, I mean the company in Vietnam, to arrange the house leasing contract and payment directly with the landlord. And of course, in the contract, it should mention the name of the company rather than the name of the individual employee. Yeah.
Yeah, thank you. So we still have opportunity to view a 50%, right? Threshold. Okay, with the proper documentation. Yeah, quite clear. The next question is, are employee transfer between member companies within the same group eligible to authorize the company to conduct VAT finalization on their behalf, or are they required to self-declare or self-finalize? If the authorization is not allowed, how can the company support employee in VAT finalization? So I hope, Thomas, can you address this question?
Sorry, I just get lost the connection. So
can you hear me? Yes. Tan, hello. Hello, is it unmute?
Okay, hello. Can you hear me now?
Yes. Yeah.
Okay. So actually, for this question, technically the answer is yes. As long as two companies are within the same group in the same system, then the new organization can handle the withholding personal income tax finalization on behalf of the individual employee. However, I just would like to share with you some real experience when we receive the feedback from such kind of organization. Because the new organization, they will do the withholding tax finalization covering both periods when the employee working at the former organization and at the new organization. So in the tax system, the tax authorities, they just have the information record for the new organization for the period the individual working for the new organization only. And any information related to the tax withheld under the former organization, they will need to look into the withholding certificate. So there may be a gap between the actual situation and the record under the tax system. That's the reason why technically the new organization, I mean the new company, they should and they have the obligation to receive the authorization from the individual employee if the employee qualify the conditions. However, in reality, we see that number of the company, they try to ask the individual employee to handle the annual tax finalization by themselves to avoid the situation that in the future the tax authorities may try to reach out to the new company to ask why our record in the tax system not consistent with what you mentioned in your annual withholding tax finalization. So this is the real situation we see in practice, just to share to you. Yeah, but technically based on the tax regulation, the answer is yes.
Okay. Hope the answer from Tan is quite clear for you. Because in many cases, they transfer from back office into the newly set up company, so they don't expect to have many finalization. But you mentioned in prudent way for the last transition year you can do self finalization for yourself first, right? The next year come back with authorization through company. Okay, thank you. Another question for employee who sign a probation contract and then do not sign a labor contract and only work for less than 3 months. Should VAT be declared under full tax rate schedule? The full tax rate here mean about, I hope this should be pro rata tax rate, right? So I think Thomas, can you answer this question? Only sign only labor probation contract and work less than 3 months and then they leave, right? So would 10% or progressive tax rate to be applied in this case? I couldn't hear you, Thomas.
I can handle this.
Okay. I think it might be 10%. Is it 10%?
Yeah, just 10%.
Yeah.
Because under the probation contract, and then the individual will not convert into the official employee, because I say that only work for less than 3 months. So just 10% cannot be converted into the progressive tax rate on employment income as the official employee. Yeah.
Yeah. Okay. Thank you. Another question: non-salary benefits such as gift or shopping voucher with the same or different value included in the VAT taxable income if they are taxable when it's time for tax declaration. So, Ms. Vân, can you help with this question? Please provide me. Thank you. Do you need the non-salary benefits such as gift or shopping voucher would be VAT taxable income or not?
So this question about the PT.
Yes, personal income tax. Yeah.
And let me handle this question.
Okay. Thank you.
Yeah. Because you already mentioned this is the non-salary benefit. I mean, this is the benefit in kind. And this benefit in kind incurred because the individual is the employee of the company, right? So it should be considered as the employment income. This is the first point. As the employment income, either in cash or in kind, they should be included into the taxable income. And the next question, in terms of the taxable timing, under the current tax regulation, PAT will be triggered at the cash out basis. So at the time this benefit is provided to the individual employee, it should be included in the relevant monthly withholding tax declaration. Yeah. Hope that my answer can address the questions.
Yeah, that's quite clear. I received the question, but not sure. Do the foreign employee need to register a personal identification number to convert their personal tax cost from 10 digits to 12 digits like Vietnamese citizens? I'm not really sure. Can you do foreign employee need to register for personal identification number
so
to convert?
I would like to repeat my understanding on the question that the question is in terms of the foreign individual. So now they have the tax code number of 10 digits. Do they need to convert into the 12 digit as a Vietnamese citizen? Up to now, not yet. up to now for the foreign individual, they still continue using the current tax code number for the PAT declaration, unlike the Vietnamese citizen. But we need to monitor and keep updated with any further requests or further change from the Vietnam personal income tax regulation and the requirement from the tax authorities. Yeah.
Okay. Yeah, it's clear. I hope this is the last question. Is this required to issue the VAT withholding certificate to all employees who do not authorize tax filation, and when it comes in for issuance? I read again. Is it required to issue VAT withholding certificate to all employees who do not authorize tax filation? Okay, does it mean that they have many short income and need to do the self filation? So the question is, the company need to issue withholding certificate or not, and when to issue for that? Any of you can have a question?
If the individual the individual employees do not authorize the company to do the annual withholding tax filation on their behalf, and if they request the company to issue the withholding tax certificate, of course, the company will hold the obligation to issue and provide such kind of document to the individual employees. But it should be based on the request basis of the employee. Because for certain case, when the employee, they self-identify that they will have the overtax payment, or for some reason they would not like to do the annual personal income tax finalization, then it's not necessary for the organization as a paying entity to provide such document to them. It should be based on the request. And for the timing, if the individual employee, they do the annual personal income tax finalization by themselves, the deadline will be by 30 April of the following calendar year. For example, 2025 VAT finalization will have a deadline by 30 April 2026. So the company should arrange to provide such kind of document to the employee as soon as you can, so that the individual still have enough time for them to prepare for the annual finalization to commit with the statutory deadline.
Yeah, thank you, Thanh. I just checked with organizer, seen the normal question from the chat box and also the registration. So I think our session is quite efficient. It's 30 minutes ahead, right? And once again, thank you very much for our guest speaker, Mr. Thomas, Ms. Thanh, and also Ms. Vân, for your time spent with us today to provide very lot of insightful information for the new law VAT and also the social insurance regulation. I hope that those information can be used effectively in your daily works. But for VAT, as I mentioned earlier, we still have two ways for the decree and the circular. Hope you can provide more guidance and also provide more easier procedure for the implementation, given now already the end of January. So have more time for accounting and finance or human resources department of each company to follow. And thank you very much for EuC for hosting this, especially for the tax and transparency committee, and also for human resource and training committee for doing the hard work for last 2 weeks for preparation. And dear participant, thank you very much for your registration, attending for today, and hope you can have more productive working with ahead. Thank you very much. And stay tuned with the next agenda or next event of EuC. I think within February after Lunar New Year holiday. Yeah. Thank you very much.